Hi everyone, so today I'm going to be doing a new company. It's called Boston Scientific. This is going to be a stock analysis video, so let's get right into it. All right, so I'm going to go ahead and share my screen, and we are going to take a look on what they actually do, how they make money. And they are a company that develops, manufactures, and sells innovative, minimally invasive medical devices to hospitals, healthcare providers worldwide. Their revenue is driven by mostly its cardiovascular, rhythm management, neuromodulation, and endoscopy, with significant growth from pioneering technologies like Farapulse ablation system and Watchman stroke protection. So the cardiovascular segment, which, yeah, it even says it here, the largest revenue of growth, over half of the total, focusing on interventional cardiology, stents, balloon catheters, and peripheral interventions, with major growth from the Farapulse system. Rhythm and neuro segment produces pacemakers, defibrillators, and neuromodulation devices for managing heart rhythms and treating chronic pain. MedSurg, including advanced technology for endoscopy, gastroenterology, and urology, pelvic health. And you have the innovations acquisition. They invest heavily in R&D, maintain a robust venture capital portfolio, and they have global expansions all over the world. So great to see. Now, we're going to take a look at their most recent earnings report, and their most recent earnings report was very good, actually. This came out on October 22nd, 2025 for Q3 of 2025. So it's a little bit old now. Q4 is going to be coming up soon. I want to do that after. But let's take a look at Q3, and we could tell here that the EPS was 75 cents, up 19% for 19% from a year ago. The figure beat the Zacks consensus estimate by 5.6%. Good. The quarter's adjustments, including certain amortization expenses, goodwill, and other intangible assets. All right. Reported EPS for the third quarter was 51 cents, reflecting a 59.4% jump from the year ago's quarter, 22 cents. So good to see it again. The revenue details of the company: revenues totaled $5 billion, up 20% year over year on a reported basis and 19.4% on an operational basis. Organic growth adjusted was 15.3%. So top line surpassed the estimate, exceeded the company's guidance 17 to 19%. Again, really good for them. Really good. Yeah, nothing to complain about. Keep in mind that Q3 revenues, they want to add this in the article, most come from the US, or we could say 27% United States. You have 2%, 3% coming from Europe, Middle East, and Africa. And then in Asia, it is 16%, 17%, we'll say, and then 10% in Latin America and Canada. So, yep, good to see. And then this talks more about the different segments of the revenue. So MedSurg, again, they were talking about it up 16%. Endoscopy unit generated 747 million. Urology, and then you have cardiovascular and things like that. So, yeah, it's not as important as, of course, as the overall earnings, which really were the shining feature of this. Now, we're going to take a look next at Simply Wall Street. So, Simply Wall Street's going to be okay with the free cash flow. Currently, we have 3.8 billion. The next 3 years, it's going to be 4.5 billion. So it's not exactly growing as fast. It's growing a decent amount, but it's not as fast. In 3 years, who knows? Maybe it would be a little bit higher. Maybe it would be closer to a double. But for some reason, they only have until 2028. It should really be to 2029 now. But maybe they didn't update it. They could possibly update it for the next quarter, though. The financial health of the company, yeah, I understand what they're saying. Like I said, a lot of R&D, research and development, is going into that. So naturally, they're going to have a lot of debt because they have to keep reinvesting into newer and newer products. But you have a lot of equity, debt's in the middle, and then you have lower cash. And you just have to be careful. The net debt to equity ratio, it highlights it there. And the long-term liabilities highlights it there as well. So just be wary of that. Now, we're going to take a look at my DCF. My DCF is going to say that it is 20% overvalued. Yeah, I probably agree with that. When we check Wall Street forecasts, I think Wall Street's a little bit too bearish. They're 40% overvalued. Yeah, I think that's a little bit too ridiculous. Currently, they're trading at 94 bucks a share, but yeah, that's like very bearish. I mean, it's possible it could get back to those prices, but there'd have to be a significant sell-off in the stock, and it's been doing quite well, as everyone could see. Now, when we take a look at Boston Scientific, where it's been trading at, currently it's at $93 a share. We have it's a 52-week low of 85.98 and a 52-week high of 109.50. So it's certainly trending downwards, similar to that 52-week low range. I would say perhaps that it could possibly hit there, but you never know. I mean, the earnings are good. We'll see how Q4 does though. And lastly, we're going to take a look at Tipranks. And let me just get rid of that ad. But excuse me a second. So Tipranks is going to say that it is 70 buys. It's going to be a totally strong buy. You have 31% upside, a low of 100, an average of 122, and last price was 93 bucks, like I was saying. Yeah, I mean, I think I generally agree that there's certainly upside. However, the problem is the shares are quite high just based on DCF. So I'd probably wait more for a sell-off. I think the company's great. I really like what they're doing. I understand it. I think it's pretty easy to understand. But we're going to cover Q4 to see how they're doing from there. It's coming out in a couple days. All right, thank you, everyone.